Some people think wealth is built by earning more, but in reality, that's not how the largest fortunes operate. There is a quiet difference between people who build wealth through income and people who build it through ownership. A difference so simple it almost feels invisible at first, and yet it shapes everything about how money moves in modern society. It begins with a strange idea that sounds almost wrong when you first hear it. Borrowing money is not income. That single distinction changes the entire game. Because in most people's lives, money comes in, taxes are taken out, and whatever remains is what you actually get to keep. Work harder, earn more, pay more. It feels linear, predictable, fixed. But in another part of the system, money doesn't move like that at all. Imagine someone owns an asset that has gone up in value over time. A property, for example. Not because they sold it, but simply because time and demand pushed its price higher. Now they face a choice most people never even think about. Sell it and trigger taxes on the gain, or keep it and use it differently. Because that asset, sitting quietly on paper, can still be used like a tool. A bank will recognize its value, and against that value, money can be borrowed. No sale, no transaction that counts as income, no immediate tax event, just debt secured by something they already own. And suddenly, wealth begins to behave differently. Not as something you earn once, but something that can be continuously extracted from, without being reset by taxation in the same way wages are. This is where the system starts to feel unfamiliar to most people. Because while workers trade time for income, and income is taxed immediately, asset holders operate in a different rhythm. They can delay, structure, and reshape when and how gains are realized, not by breaking rules, but by staying inside them. The real shift begins when this idea stops being a one-time strategy and becomes a cycle. An asset grows in value. Money is borrowed against it. That borrowed capital is used to acquire another asset. That new asset may also appreciate, produce income, or unlock further borrowing potential. And the original asset is never sold. On paper, nothing has been cashed out. So nothing has been earned in the traditional sense that triggers taxation. Meanwhile, the system continues moving forward. Value compounds across multiple holdings, each one reinforcing the next. It sounds almost too smooth. And that's where the misunderstanding usually begins, because none of this is risk-free. Debt is not invisible. It has interest. It has repayment pressure. It depends on the stability of the underlying assets. If values fall, the entire structure becomes fragile very quickly. Many people who attempt this without discipline or scale end up overexposed rather than wealthy. But at the highest levels, this isn't treated as a shortcut. It's treated as a structure, and structures behave differently from income. To understand why this exists at all, you have to look at how modern tax systems are designed. In most developed economies, including the United States tax framework, income is taxed when it is realized. Wages, salaries, and business income are visible, trackable, and immediate. But borrowing is not classified as income, because legally, debt is not considered an increase in net worth. It is a liability balanced against an asset. Money received through borrowing must eventually be repaid, so it sits in a different category entirely. That distinction is not a loophole. It is a foundational principle of modern finance. And once you understand it, a lot of behavior that looks confusing from the outside starts to make more sense. Why would someone avoid selling a winning asset? Why would they prefer to borrow instead? Because selling is final. Borrowing is temporary. Selling locks in a taxable event. Borrowing delays it indefinitely, as long as the structure holds. This is where real estate becomes central to the story, not because it is the only asset class that allows this behavior, but because it is one of the most accessible forms of collateral for ordinary investors. Banks understand it, markets price it, debt can be attached to it with relative ease compared to many other assets. Over time, this creates a pattern among long-term property holders. Buy an asset, let it appreciate, extract equity through refinancing or secured loans, reinvest that capital into new assets, and repeat. Each cycle is not just about growth, it is about preserving ownership while still accessing liquidity. But there is another layer that complicates the picture. Because while borrowing delays taxation on appreciation, the tax system does offer other mechanisms that can reduce taxable income through ownership itself. In certain investment structures, especially those tied to active management and real estate operations, depreciation can be used to offset income. This doesn't mean the asset is losing real-world value. It means the tax system allows investors to account for wear, aging, and theoretical value decline over time. In some cases, this can significantly reduce taxable income in the short term, which is why real estate has historically attracted not just homeowners, but structured investors looking to align cash flow, leverage, and tax treatment. But even here, the system is not one-directional. Those reductions are often temporary. Depreciation can be recaptured later. Rules around passive activity losses, material participation, and rental classification determine how and when these benefits actually apply. And this is where the gap between perception and reality becomes important, because online, these strategies are often presented as if they create a permanent escape from taxes. In reality, they shift timing, structure, and exposure, not elimination. Still, one feature of the system remains especially powerful across generations: the moment of inheritance. In many tax systems, when assets are passed down after death, their cost basis can be adjusted to current market value. This means unrealized gains that accumulated over decades may no longer carry the same tax burden if the heir chooses to sell immediately after inheritance. This single rule changes how wealth behaves over time. It turns decades of growth into something that can reset at a generational boundary, which is why long-term wealth preservation is often less about annual income and more about control over timing. Control over when value is realized, control over when tax events occur, control over whether assets are sold at all. For someone earning a salary, none of these controls exist. Income arrives and taxation follows immediately. There is no deferral mechanism, no structural flexibility, no asset base to borrow against. The system is not identical for everyone, but that does not mean it is hidden. It is written clearly in financial law, tax codes, and lending practices. The difference is not secrecy, it is participation. Most people never enter the system where these rules become relevant in a practical sense, not because it is forbidden, but because it requires ownership, capital, risk tolerance, and time. And even for those who do enter it, success is not guaranteed. Leverage amplifies everything. It can build wealth faster than almost any other mechanism, but it can also collapse under its own weight when conditions shift. Interest rates rise, asset values stagnate, cash flow weakens, and the same structure that once looked like financial freedom becomes a burden. So the real question is not whether borrowing against assets works. It does, under the right conditions. The real question is why modern systems make ownership so central to long-term wealth outcomes in the first place, and what it means for a world where one group earns money through labor that is taxed immediately, while another group grows wealth through structures that are taxed far less frequently, but far more strategically. Because once you see that distinction clearly, it becomes difficult to unsee. And it forces a quieter question in the background, not about whether the system is fair or unfair, but about who exactly it was designed to reward in the first place.